Saving for a house isn't just save a down payment. If you miss the other costs, you'll feel behind fast. Here's what you need to know. Saving for a house works best when you stop treating it like one magic number. The down payment gets attention, but upfront costs stack on top of it, and they can surprise you. Closing costs often run about 2% to 5% of the purchase price, and they're due at the same time. Lenders may also want reserves, meaning extra months of housing payments in the bank. Your timeline matters because the closer you are to buying, the less risk you can take. And small bank fees quietly drain momentum over months. The fastest way to feel in control is to turn buy a house into a math target. Start with a realistic price range, because every other number is a percentage of that. Then set a down payment range, whether it's 3, 10%, or 20%, based on what you can actually reach. Add a closing cost estimate of 2% to 5% so you're not scrambling later. Next, build a cash buffer for inspections, moving, and first month surprises. Once you total it, convert it into one monthly savings number you can automate. Your plan only works if the money gets saved before you can spend it. Open a dedicated house savings account so the balance stays separate from your day-to-day life. Schedule an automatic transfer on payday because willpower is unreliable. If your pay hits one checking account, split it into buckets so bills and house savings don't compete. Automate the extra paycheck months instead of letting them disappear. Add friction so withdrawals take a day or two, and also watch savings transfer limits or fees so automation doesn't backfire. Where you keep the money matters because the wrong account makes saving easier to break. Keep house savings separate from spending money so you don't mentally treat it like available cash. Don't park it in checking long term, since checking often pays little or nothing in interest. A high-yield savings account usually gives flexibility while still paying you something for waiting. Money market deposit accounts can also work if they pay well and you understand any minimum balance rules. Be careful with CDs because they can lock your timeline with early withdrawal penalties. Whatever you choose, keep it FDIC or NCUA insured. As you get close to buying, your job shifts from save to don't create lender problems. Freeze new debt because a car loan or new card can change your debt-to-income ratio fast. Document large deposits since lenders commonly ask for paper trails on unusual inflows. Avoid cash transfers you can't prove because cash is hard to source. Never miss payments because one late mark can hit your mortgage approval and pricing. Keep a reserve cushion so you don't drain the account right before underwriting. And plan to use ACH or a wire for closing instead of showing up with cash. Closing costs alone can run about 2% to 5% of the purchase price, so your real target is bigger than the down payment. BankingHub matches you to accounts based on how you actually bank and shows the real dollar impact for your balance, free, takes about 2 minutes, and the link is in the description.